Well, it's been another very ugly day for world markets. You saw Brent crude drop below $65 a barrel. You saw a remarkable fall in bond yields across the world. Perhaps most impressively, Treasury 10-year yields are now below 2.2%. They're below where they were before last Friday's very impressive payrolls report in the US. And the stock, and when you look at the stock market, the S&P 500 has dropped 1.6% today. Why was this? Largely because there is worry about the global economy. Perhaps the critical data points were in China. We found out that producer price inflation was at a 5-year low. And from OPEC, we heard that they expect demand for their oil to be a 12-year low next year. Plainly signs that the global economy may be slowing down. This feeds into a question of what used to be called decoupling. We heard a lot about this before the 2008 crisis, and then the idea was that the rest of the world could decouple from the US and flourish even if the US went into a slump. That turned out to be wrong. Now the question is the other way around. Can the US continue to march ahead even if the rest of the world slumps? I put that question last week to Jeffrey Kleintop, who is the chief equity strategist for Charles Schwab.
The U.S. can continue to move forward next year economically and in stock market performance, even with the rest of the world dragging behind it, but only to a certain degree. It doesn't work the other way around. If the U.S. falls into a hole, the rest of the world tends to follow behind it, largely because the U.S. is the consumer of so much of the world's exports. It doesn't work the other way around. The U.S. only exports about 13% of its GDP to the rest of the world, so the U.S. can actually stay afloat even as the rest of the world bounces around, as it has for the last few years, with Europe in and out of recession and Japan entering recession this year. However, there's a speed limit. The U.S. can only go so fast with the rest of the world dragging behind it.
Now, I agree very much with Jeff's analogy there with a speed bump. If I could expand it a little, speed bumps tend to be good for you. They can improve safety, but they can still cause a lot of damage if you approach them driving too fast. I think there is a very important analogy there for the US stock market.